What is DCA in crypto? If you're watching this video, you might be a broke college student or a broke adult who wants to get into Bitcoin. But after all this hype about crypto, you might think that you have missed the boat. But don't worry, there is still hope. Welcome to Cryptela. We're here to give you solid advice to grow your crypto market portfolio. So let's jump straight into it. If you want to be a long-term investor of crypto, then the dollar cost average will be a great strategy for you. In the world of cryptocurrency, DCA is an acronym that stands for dollar cost averaging. This strategy is a simple and effective way to reduce your overall risk when buying a new asset like Bitcoin or Ethereum. When you dollar cost average, you're essentially buying the asset at different intervals and prices, averaged out over time. This technique can help take the emotion out of investing and has been shown to be an effective way to reduce risk and improve long-term returns. In my opinion, dollar cost averaging is the best way to buy crypto, especially if you are an inexperienced investor. How does dollar cost averaging work? If you ask a long-term investor, they'll say slow and steady is the way to go for them, and this is dollar cost averaging. It gives you profit while ignoring the ups and downs of the daily and weekly graphs. In this strategy, you divide all your total big investments into small investments and then invest them in the market regularly. For example, if you want to invest $2,000 in a year, you then break this total into smaller numbers and invest that small number every month, week, or day. It is a very profitable investment for crypto investors as compared to lump sum buying and selling. It lowers the chances of risks that come with the crypto market. If you would have followed this strategy back in 2017 and invested $100 in Bitcoin every week till the end of January 2021, you might have invested $16,500 and your portfolio would be worth $65,000. It is a return on investment of more than 299%, which is great. Dollar cost averaging example. Let's say that you want to invest $1,000 in Bitcoin. You decide to buy $50 worth of Bitcoin each week for 10 weeks. The price at the time of your first purchase is $500 BTC, and you buy 5 coins for $2,500. 2 weeks later, the price has risen to 600 BTC. You buy another 5 coins for $3,000. 2 weeks later, the price has risen to 650 BTC. You buy another 5 coins for $3,500. This pattern continues until you've bought 1,000 coins at 10 different prices over 10 weeks. This is a perfect example of dollar cost averaging. The price of Bitcoin will eventually go up, but if it goes down, you won't lose all your money. Why do people trust dollar cost averaging so much? People trust dollar cost averaging because it smooths out the effects of market volatility, reduces the possibility of making emotionally driven investment decisions, and provides a disciplined approach to investing. By investing a fixed sum of money at regular intervals, investors can purchase more shares when prices are low and fewer shares when prices are high. But over time, this technique can help lower the average cost per share of an investment, which can lead to higher returns. Dollar cost averaging is an investing technique that involves buying a fixed dollar amount of a particular investment on a regular schedule, regardless of the share price. The investor buys more shares when prices are low and fewer shares when prices are high. Over time, this technique reduces the effects of volatility and market timing and can produce better returns than trying to time the market. Many investors use dollar cost averaging because it takes the emotion out of investing and can help them stay disciplined. The technique can also be used to help spread the risk of investing over time in case the market turns down. Dollar cost averaging is very simple, and you can start doing it today. The sooner you start, the better. If you wait until your company's stock price has risen substantially, you will have missed opportunities to buy at lower prices. Why DCA is so good in crypto. DCA helps to smooth out the volatility that is inherent in cryptocurrencies. By buying into an asset regularly, investors can average down their cost basis over time, which can help to increase profits when the asset's price eventually rises. The main reason why DCA is so good in crypto is that it helps to smooth out the volatility that is inherent in cryptocurrencies. By buying into an asset regularly, investors can average down their cost basis over time, which can help to increase profit. Another reason why DCA can be beneficial is that it takes the emotion out of investing. When asset prices are volatile, it can be difficult to know when to buy and sell. By committing to a DCA strategy, investors can take emotions out of the equation and simply focus on buying an asset at regular intervals. DCA is a very classic investment strategy in which you make very small investments throughout the year as compared to the big investment at once. Many investors have applied this strategy to stocks and have gotten good profits, so you can also apply this strategy to crypto investments. Before we go any further, subscribe to our channel, Cryptela, so that you can get more authentic news and strategies from us. Cons of DCA. When it comes to DCA, there are some drawbacks to this strategy. It lowers the chances of risk, but when the risk is low, the reward is also low as compared to the lump sum amount. It is not a good strategy to maximize your investment, but it is more of a risk management strategy. The other drawback of this strategy is that many crypto exchanges charge a fee on the buying, selling, or trade of the crypto, so you may pay more fees with this strategy. But that depends on your crypto exchange, currency, and many other things. So before applying this strategy, make sure you get all of the knowledge about the fees and apply the strategy afterwards. That's it for today. Make sure you subscribe to our channel and hit the bell icon so you never miss any updates from Cryptela.